to set up the macro conversation here today. Ben, you've got a lot of good analysis and charts and a couple of your latest notes. I want to start on the economic side and what we're seeing in terms of the data over the last month. Not just the vaccines, right? The vaccine is kind of this impulse for the economy, but what about the real numbers as well? Let's go to PMIs first, because it seems like we're still moving mostly in the right direction pretty much everywhere.
Hey Oliver, thanks for having us again. Yeah, it is actually. Yeah. The China numbers are important, obviously, because that really has set the tone for the global economy. And so there was good news out on this for last night. So that shows that momentum in particularly prices paid and shipments and inventory, that's all moving still along. At the same time, we will get out ISM data tomorrow, which I think are critical for the markets, because the data in the US, particularly the regional data, and you saw that today in the Chicago PMI too, that has weakened a bit. And so I wonder how the ISM data will play out here because of the, let's say the lagged effect from the COVID wave that Europe has faced, what we are getting currently. And as you were just talking with Nicole about it, like, it doesn't seem that we're having that effect from COVID wave just yet on economic activity because of consumers going out there. So that's an important number. Obviously, the rest will come after that with Europe and Asia. I think particularly Asia Pacific region, that has been such a beacon in this global economy because they got the virus so much better under control. There's a whole group of them coming out, I think, on Wednesday. That's key to watch too.
Ben, when we look at the trajectory of some of these numbers, I mean, Chicago PMI solid today, even though it slipped a little bit, still 58. I mean, that was red hot last time. So maintaining 60 and plus, I don't think was going to happen. But if we go back to the chart here of the global PMIs, the services, manufacturing, I mean, in terms of the trajectory, can they continue at the rate that they have been without any additional help? Are we still getting boost from what happened back in March, or is that just to put the bottom in? I mean, it seems like some of these are now taking on a more organic level of growth here to some degree. This doesn't necessarily look like a chart that's like screaming out that we need a huge injection. Is it? Or am I wrong?
No, I think you have a good point. Like, you're getting this self-sustaining trend in the economy after you boosted it in March, and that boost is still lingering out there, meaning we had it here with the CARES Act, probably the biggest boost, but that has happened in Europe and other places. So that's, I think, an important backdrop against the fact, I think, that what really happened was that as China got its economy much quicker back on its feet, there's been a lot of boost coming from that. I think that China's recovery has been so resilient, and that has been spurring this manufacturing industrial recovery, as I call it. And that also has to do with the supply chain, right? People thought the trade war had changed the supply chain, but it actually was not. And there's a lot of demand for China, goods, let's say industrial goods and intermediary goods. And so I think that is all part of the activity that you're seeing coming through those PMI indices. Obviously, PMI is a survey and it's forward-looking. So the one element that people always watch is new orders. That is obviously key the next few days. If these new order numbers start to really click down, particularly for the services PMI, then that would be somewhat worrying. But it's self-sustaining at this moment, so it still looks very robust into this fourth quarter, which means I think the U.S. economy could still grow at a sort of a 3 to 4% clip this quarter.
One of the charts that I like a lot right now that you hint at as well in your note is looking at copper versus gold. I mean, it's just this stark difference. And if you apply the traditional way of viewing these assets, copper is being that indicator of global health, and gold is being a hedge to either chaos or maybe inflation. If you kind of take Bitcoin out of the scenario, as many would argue on the Bitcoin side right now, that's got something to do with gold's loss. So just put that to the side for a minute. Who knows? Maybe, maybe not. Right now, the move in copper, as we see here on the chart in the top right, that's the one that's zooming the most. Then on the other side, we also see some of the inflation expectations for the Eurozone start to creep up a little bit. How are these connected? And should we believe copper right now, Ben, is something that could lead to show us an economic bounce that maybe creates inflation? Or is that still, a gamble like anything else to assume that growth will bring inflation?
I don't think we're going to see like a surge of inflation, but I do think that the prices paid component in the ISM data that was on the other chart was really showing a really nice healthy V, and copper is a part of that, right? Copper has such an input to all this let's say, industrial goods again. And I think also has to do maybe with some pent-up demand for green investing, that is all part of the copper drive. And that Dr. Copper, as they say, right, the PhD in economics, is much right this time about the course of the economy, suppose, and that gold fading is really that sign of that, yeah, there is no need anymore for major tail risk. That's really taken out by the vaccine. So I think then if you take that to inflation and inflation expectations, we collapsed in March and we've come up nicely in the US, but Europe is always behind, and the data in Europe too, the German CPI data, regional data, was still pretty weak. But there's some interim signs there that too, that's bottoming, so we're not ending up in deflation. So I think copper trend highlights more we're not ending up in deflation. We're going to return to more healthier level of inflation, which is probably closer to 2%. I think that will play out next year, which then also makes the central bank story very different next year if we do reach that point.
Ben, right now it seems that we've had this kind of a pause in the reopening and cyclical strength the last few sessions, and it kind of, I'll be a little conspiratorial here, it kind of lines up pretty well with when the Yellen announcement was made. Do you think markets right now are trying to think about what a Powell-Yellen team might mean for keeping rates lower or bringing new stimulus into the market? I mean, it seems like the stimulus has been mostly a policy and politicians' conversation, but I don't know, is it a coincidence we're suddenly getting all this kind of growth and momentum strength come back after Janet Yellen was announced as Treasury Secretary?
Yeah, so people make that inference because of her background of labor economist, and then having been the chair of the Fed and having followed the policy of such a really careful, slow normalization of interest rates. I even remember, like 2015, there was such a speculation on the first rate hike, and she so carefully projected that rate hike that was much of a stimulus to markets at that time in the following year. So I think her role in the Treasury is interesting because she will probably look at those facilities that they had run, the PPP program and the Main Street Lending program, what you can do more with that to affect unemployment, given her labor economist background. The other part I think is important is the dollar, right? Because Treasury is actually overseeing the policy of the dollar. You know, during the Mnuchin period, he made at times certain comments about the dollar were not always, like, I think, perfectly timed maybe. She will be very different about it, so there could be very much more cohesive dollar policy statement. Lastly, of course, everybody's looking at what will now happen with all the sanctions that have been put out there against Russia, against Iran, against also China, and what will happen with that. She will play a role in that, right? And that too, I think, is maybe more of a, let's say that she takes a more moderate view there on these particular issues, and that markets don't have to maybe worry so much about more sanctions and more counter measures against the different countries.
Okay, so right now it doesn't seem like the data suggests there's been any shift in the recovery story. Maybe the policy side will play a role in terms of shifting the landscape a little bit, but in the short term, Ben, nothing, it seems from these charts, suggests that the recovery has turned around. Doesn't even look like it's slowed much. Maybe if you look at some of the employment numbers we've got and jobless claims. But the last chart I want to bring in is from another report of yours to kind of connect these points, which is are there any cracks or vulnerabilities within the credit side of the market that suggest they need more stimulus? It seems to me from this chart you've got on duration that the biggest risk for credit is not like fundamental breakdown, but just that yields start moving quickly or we do get some inflation.
Yeah, that's right, Oliver, because that chart actually, if you look at, call it duration, is the interest rate sensitivity of bonds, right? So credit bonds tend to be a bit less sensitive than treasuries. Now, with this rally that we've had over the last 2 years almost, credit duration is really high and equal to the treasury duration. So that sensitivity to interest rates is very high at this point. So if we do get even a slow normalization of treasury yields, that could impact the credit markets. And I think that could be a story next year, that you're going to get this different situation where the credit market that was such a supporting factor for the equity market this year because of the backstop and because of basically the flow into credit, and that the economy recovered, credit markets now signaling more like, while the economy is working, there's no real stress, but the interest rate normalization may start happening as of next year. Then we'll see negative returns in credit likely, and I think that that would lead to repositioning away out of credit into other alternatives, perhaps indeed to commodities or to other areas. So credit is to be watched. It's not a recession indicator at this point. It's more like interest rate sensitivity risk.
Okay.